Hello, Facebook and YouTube and LinkedIn. This is Louis Llanes, founder of WealthNet Investments. I thought I'd go live today because there's been a lot of news coming out. A lot of people are talking about the markets. They're feeling like unsure about what's happening. So I thought I would just talk a little bit about some of the stuff that's going across my desk right now. Uh, there's been a lot of talk about there being a lot of signs for a top in the market. We've had a ton of initial public offerings going on, which typically tends to be a indication of a top. A lot of these companies are kind of blank check companies. I don't know if you've heard about these, but they're called SPACs. And basically what they are is they're special purpose investments that are put together. They raise a bunch of money in the market, and then they have the ability to just go out and buy companies. And so you're seeing a lot of money just pouring into these companies. And that's really speculative. Another thing that's come to our attention that seems to be speculative, indicating a market top. And by the way, I'm not saying there is a market top, because I'm going to talk a little bit about why I don't think it's a market top, but I want to talk about why people are saying it's a market top first. People are talking about inflation and how inflation is persisting. And it's true. Inflation started off to be kind of this is transitory, and then it became, this is kind of annoying. Now as it's been building up in the energy sector, and we're realizing that it's going across the entire economy, more and more of the economists that were kind of saying that it's temporary are starting to hedge their bets. So it may not be temporary. Another thing is leverage is huge. Leverage obviously is debt. We look at the margin debt. There is a ton of margin debt out there right now. It's a lot higher than normal, and that you typically see that in market tops. So that is another sign. Obviously, valuations are bloated. We've had, obviously, if you look at the multiples to earnings, assets, they're definitely bloated and on the expensive side. So that indicates a top. A lot of IPOs are in lockup. So this is one of the things we've been noticing with clients, as well as just looking out what's happening with various companies that have basically people are getting company stock, and then there's periods of time where they're in a lockup, and then there's a time when they can sell. Now, as those lockups are released, that could lead to selling. The insiders start to sell. They usually need to pay for their children's education or other things, and they start using that money to sell. So there are people that believe that this insider selling is likely to increase, and that will bring the market down. We did see that happen in the dot-com bubble. So that's something that people are seeing or thinking. The Fed needs to be tight. So that's one of the concerns right now. People say, hey, look, the Fed needs to tighten things. Rates are way too low. And if you look at where inflation is versus where interest rates are, the Fed needs to get tighter, which could hurt the market. So all of these things are out of your control, right? And it looks like this could be a top. But one of the lessons that I learned, and I talk about this in my book, Financial Freedom Blueprint, by the way, that's coming out November 16th, and you should pick up a copy of it. I talk about how these things can go way beyond what you think they're going to go in terms of price. Because I'm looking at all of these signs, if you will, of a top, but then I look at the technicals, and I look at what the supply and demand is, and it continues to look positive. And in fact, some of the indicators that would say of there being a top that you normally would see are not there yet. So my argument is that we have not entered a top yet, and that we are likely to continue to see rising prices in equities. And I don't think that it's over yet. So I want to actually share a chart with you. So I'm going to share this chart with you. Hopefully you could see this. There you go. So what I have here is a chart of the S&P 500. And obviously we've been in an uptrend, and I'm looking at year-to-date numbers. So on a year-to-date basis, the S&P 500, and I'm using the SPY, the spider, the S&P 500 spider as a proxy. On a year-to-date basis, it's up 19.52%. And these are large companies. If we had such a crisis developing, you would imagine that gold prices would just be skyrocketing, right? and I'm just going to overlay gold on this. If you see what I just did here was overlay the gold price. This top graph is the S&P 500 and the bottom graph is gold. And you can see gold is actually down 7.34% for the year. So we're not seeing a follow through with gold. But what we are seeing is a massive run up in Bitcoin. So I'm going to overlay Bitcoin here. And you can see Bitcoin is up 45% on the year, and we had a massive run up from this sell-off. Now we were up as high as 77%, or what is that? 77%. We were up as high as 77% year to date on Bitcoin. It had a big drop, and now it's up 45% in the year. Very, very volatile. So we've seen this massive move into the digital currency. So why am I bringing this up? I'm bringing this up just to show that if you look at the market itself, if these problems were really in existence today and the market was beginning to recognize them, we would have a bigger sell-off. I would argue that the liquidity that's present in the market right now leaves us very few choices. And really what's happening is we're having kind of a stealth bear market where there are companies that have been bought too high that are selling off, but then that money is rotating into other companies that were not so speculative. And a prime example would be if you look at real estate, and we've been bullish on real estate prices are up. If you look at the real estate investment trusts exchange traded fund, I'm looking at the Vanguard one, you could see it's up 25% on the year. So that's really showing you what's happening here. We're having this rotation, and I can go into individual stocks and show you how this is happening, but it's really clear that we are not in a bear market just yet. There's a lot of people calling for that, but we are definitely seeing inflation. One of the things that we own is the agricultural commodities. This is an exchange traded fund that tracks the agricultural commodities, your grains, the wheats, the corns, the soybeans. And you can see, agricultural commodities are up 18%, and that is filtering into, we see that at the grocery store. Those are things that we really are looking at. But gold, again, I'm going to look at gold again and overlay that. Look how dramatic the underperformance in gold is. Now, what I think is going to happen is I think you're going to see a catch up in gold. So I'm bullish on gold. And I think that as gold bottoms around here, that for many investors who are not in gold, it makes sense to diversify into gold, into silver. And that will allow you to have better diversification in your portfolio. And that's one of the things that we are definitely doing in portfolios right now. One thing that's very interesting as well is that the emerging markets, that would be mostly China, they're growing at a faster rate. Yes, there's a lot of problems. There's geopolitical problems, but look how badly it has underperformed the S&P. It is now only up 3.31%. I'm looking at the Vanguard FTSE Emerging Market Exchange Traded Fund as a proxy. So you can see this blue line, it's only up like 3%, and the S&P is up like 19%. So it's time to think about diversifying and being more broad in your diversification. And when we're looking at people's portfolios right now, what we're finding is that people are not diversifying. They're just way too concentrated in just those names that everybody has heard about: Microsoft, Amazon, Facebook, Nvidia, and then there's also a lot of speculation that we're seeing in companies that people get excited about, like Zoom or Tesla, those types of companies. And if you look at the values of those companies, I think that it makes sense for investors to be more broad than to be buying those kind of everybody knows about it type stocks. And the reason why I'm saying this is because if you go back in time and you look at history, I'll use an example. There was a time when we had what was called the Nifty 50, and that was back in, I believe it was in the 60s. There was this concept of the Nifty 50. There was 50 companies that they were such great companies, no matter what, you could just buy them. It didn't matter what price it was. Everybody thought they were just going to go up forever. And of course, most of them crashed dramatically. And so you don't want to get yourself in that kind of a situation where you're just following the Nifty 50, because that's generally what hurts investors in the long run. So sometimes having a slower, steadier pace is better, and having more diversification is better. So when I look at the market right now, I don't really see fear. I mean, there's a lot of people that are fear mongers right now. I don't really feel that way. I do feel like the values are out of control for many companies, but you could still find companies that have good values, reasonable values, I should say, decent dividend yields, better dividend than what you can get in bonds. And they're going to grow 7, 8%. And so that's the way to continue to build wealth rather than having this scenario where you're just following the most attractive, like the Teslas of the world, which everybody seems to be wanting to latch onto right now. But if I can go back to this chart again to show you, when you look at this and you say, okay, what is the market doing and what is the other assets that are not related to the market doing, you can see that there's other areas you could be in. For example, those agricultural commodities are up very strongly. Real estate is another area. And gold, which has been languishing, could catch up. Gold is down 7%. Even though we have a lot of inflation, gold has not gone up. Instead, what has happened, most people are speculating in Bitcoin. And in full disclosure, we own all of those. We own the Bitcoin, we own gold, we own real estate, we own agricultural commodities, we own emerging markets. So the emerging markets is another area that I think long-term investors could be looking at. You know, emerging markets are up only 3% on the year, but the long-term growth expectations in emerging markets are much larger than our own, and their values are much more attractive. So even though, and let me just go out longer term, if you go out like 5 years, this is the emerging market exchange traded fund. You could see, you know, we're in a pullback right now. So a long-term investor could start accumulating emerging market equities at better valuation than the US, better long-term growth potential than the US. So in order to be ahead of the herd, you have to kind of think differently. And that's one of the chapters in my book too, Ahead of the Herd. And there's a whole conversation about what are the criteria that one should look at to be ahead of the herd so that you're not just sitting there and following and being late. So I just had a few market observations I wanted to share with you today, because I believe that being broad, diversified in these other areas will lead to better results. And that all of these lists of things that people are saying that are negative, like, like I had listed out before, the IPOs that are there, the valuations that are high margin debt, IPOs that, lockups that are going to be let go, which could lead to insider selling, the fact that the Fed probably needs to tighten at some point. And there's, these lists of things are concerns, and we should keep that in mind. And because of that, even more so today, we should be more broadly diversified in portfolios. So that's all I have for you today. Just a quick update on some of the market observations. I hope you're doing well, and I'll talk to you later.